Next topic, of course, is going to be Elizabeth Warren on Twitter. We're going to go ahead and take a listen to it. I may have to figure out how to mute my speakers here. Oh, I know how to do this. We're good. I can't put my headphones on, but I think I can. Ooh, I shouldn't have done that, should I? Let me power off. So I bought some speakers for my for my computer setup because I can't really get headphones on. Anyways, it causes some issues there. So we're going to go ahead and crank this up. Take a listen.
Cryptocurrencies like
can I hear it?
Stablecoins.
I can't hear it. Is it in this one?
It's like
no. It'll be this one. So I have 3 sets of headphones. Not gonna lie. Well, 2 speakers and 1 headphone.
Tether and
here we go. So Elizabeth Warren tweeted, excuse me. Elizabeth Warren yesterday tweeted at 1:50 p.m. Stablecoins pose risks to consumers and to our economy. Here, we'll go ahead and pull this up. They're propping up one of the shadiest parts of the crypto world, DeFi, decentralized finance. I wonder why that's shady to Elizabeth Warren. Where consumers are least protected from getting scammed. Our regulators need to get serious about clamping down before it's too late. Let's go ahead and take a listen.
So, unlike other cryptocurrencies like Bitcoin, stablecoins like Tether and USDC are supposedly pegged to the dollar. And the reason for this is to reassure people that stablecoins are as stable as using the dollars you have in your wallet or in your checking account. A stable coin dollar, in other words, will supposedly be worth a real dollar. Now, that would make it a lot easier and a lot safer to trade among different tokens, to put up collateral for a risky bet, or even to pay for a cup of coffee at your local bodega. But I want to examine whether or not the stablecoin talk matches the stablecoin reality. Ms. Goldstein, let's say that I own $10 worth of...
Okay, so there's actually a fair point here. And I'm going to give this to them. And it is that when we're talking about stable coins, it's super important that whoever's running the stable coin, right, or whatever, however the stable coin is in production, does tie itself to an actual dollar. And we have seen this problem before. Earlier on, granted, it's not as big of an issue as it used to be, but where essentially there would be more stable coin in circulation than there would be dollars backing that said stable coin. And that is something that already is regulated to my knowledge as far as like how that functions, but that can be a potential issue.
Of Tether or USDC. If I want to trade my $10 worth of these tokens, am I guaranteed to get $10 back?
No, Senator. You're sort of dependent on the exchange where you're trading it. Because as a U.S. retail customer, I cannot go to Circle and say, please redeem my USDC. And Tether explicitly says no U.S. customer can redeem Tether. So I have to trade it on an exchange. Sometimes it fluctuates. Sometimes it's a little above the dollar. Sometimes it's a little below. But if there were a run, the peg could collapse.
Okay. I mean, that's how the dollar functions as it is, right? Sometimes its value is a little higher in the global currency and sometimes it's a little lower. That's just how markets work in general. Now, when she's talking about an exchange, it's going to be important to understand the difference between when they're talking about like an exchange that is centralized, something like crypto.com or Coinbase or Binance, etc. Well, we could get into Binance and they're 2 different options as well. Or whether or not it's like something like Pancake Swap, Quick Swap, whatever, where essentially you have users that have basically added liquidity and locked up a certain amount, usually within pairings. This is how it's done to basically ensure that value is there when needed for swapping. So I'm kind of curious where they're going to go from here.
And we also don't really know necessarily what's backing all of these stablecoins, right? Tether is.
Hold on a sec. I want to get into that, okay? I promise. Because I want to just underscore this point, that if Tether's tokens were...
Did you guys lose audio? I think I'm showing audio here. I'll unmute here just to double check. It seems like I have audio, so I'm going to keep going. I hear it on my end.
were actually backed 1-to-1, it would be one of the 50 largest banks in the country. But we know that it is not. And that's because, according to Tether's own report, only about 10% of the assets backing its stablecoin are real dollars in the bank. 90% is something else, not real dollars. And if that worries you, there's a little more news on this one. The report that 10% of
So this used to actually be something that worried me, and I'll tell you kind of what my thoughts are behind it, especially as we get into talking about inflation and so on. As long as you have the assets to back up the supply that is there, I think it's okay in general. And by that, I mean, like, it doesn't have to be all 1-to-1 in US dollar necessarily. But I can see a concern there because obviously if the value of the assets go down, then of course, then you have a problem if you don't actually have the total value there. More than likely, a lot of those assets are in other cryptocurrencies such as Bitcoin is what I would presume. I haven't looked into Tether in particular, and maybe in chat you guys can chat about it and give us some more information, and everybody can help educate each other on that particular portion of what's going on here. One of the things that I think needs to be talked about is the difference between rich people and poor people and the effect of taxes and inflation and money printing on the two classes. The reason why, if you are basically rich or you have, in a position like maybe even Senator Warren here, where you have a whole bunch of money, most of the time you aren't necessarily holding on to the US dollar either. Most of the time you're holding on to other assets. And especially this is the case if you are prepared for some sort of printing of said currency that you don't want to hold a whole bunch of. Because if you can purchase the assets and then you're aware that you're going to be having, 40%, 50%, increase of printing over the past year, right? We had 40% of the total US dollar supply was printed within the past year. I think it's more than that now at this point, plus the 6%, translating right now into a 6% inflation rate, which is the highest since the 1980s. If you're rich and your net worth is built into your assets, those assets just go up in value while the dollar goes down in value. So if you're just someone that is basically putting money into your savings account, or you're living paycheck to paycheck and you're just trying to pay rent, etc., your rent's going to go up. The landlord will, of course, still maintain his net worth because in relation to the inflation and so on, because the value of his assets will go up. So when we're talking about the printing of the US dollar, and then we're talking about how these two different classes function, really by and large, the upper class is protected via assets, and they do this on purpose, which is why I talk about purchasing assets over purchasing currency or whatever, or saving money or taking the dollar. You want to generate revenue as well. But that is kind of why these two classes are impacted differently, and more significantly, the lower class you are, if that makes sense. So I want you to understand that basically when we're talking about the backing of the, a stable coin by the US dollar, that would still work, but you're almost even more protected in a scenario like we're in right now if those are in hard assets that increase in value when, of course, more money is printed because you need it to compensate for, of course, that money printing that is going burr. All right, Let's
Tether
go.
stable coins are backed up by dollars is not actually verified by a comprehensive audited financial statement or verified by any government regulator. So, Professor Allen, let me ask you, let's say I'm not the only one who wants to redeem my $10 worth of Tether or USDC for dollars. And maybe there's bad news in the market and people rush to cash in their stable coins. What would a run on the stablecoin market look like? Could it endanger our financial system?
Thank you for that question, Senator.
So I'm actually curious how she's going to answer this, because if there was a run on that, my assumption would be is that you would run out of liquidity. If we're talking about decentralized finance specifically. And the reason that would happen is because you have to have users that have liquidity added within the DeFi exchanges. So you would end up just running out of whatever that supply is. I'm kind of curious what their perspective is on it, because we also have to talk about like the centralized exchanges. They're also going to have different backings. You're going to have essentially, if we're talking about like crypto.com or something along those lines, they're going to have other, not insurances, but they're going to have other custodial options, usually through something like Gemini or something along those lines, where they're going to be able to still liquidate that without necessarily the use of decentralized finance exchanges. It seems like, at least in the original tweet, this was an attack on DeFi, but then their perception of whatever exchanges are seems to be a little bit off, or at least still including centralized exchanges. And I'm trying to interpret that, but you guys let me know if I'm going off base or on a tangent there.
Senator, so a number of the witnesses today have said that stablecoins don't engage in maturity transformation and therefore don't suffer the same fragilities as bank deposits and runs. And that's probably true to some degree. But a run on a stablecoin would look a lot like the runs that we've seen on money market mutual funds in 2008 and again in 2020. And it could also share dynamics with the foreign exchange crisis we've seen in the past, like the Mexican peso crisis. So if holders of a stablecoin suddenly lose confidence in either the ability of the issuer of the stablecoin or the reserve of assets backing it to maintain a stable value, they could seek to redeem or exchange their stablecoin en masse. And if they have direct redemption rights, that would force the issuer to liquidate its reserve of assets. So right now, I don't think that would have systemic consequences. If stablecoin holders are only using them to speculate, they're not really going to expect stability, and so runs will be less likely. But if a run did occur right now, I think the impact would probably be felt in the DeFi ecosystem. And that's why it's critical that we not provide this government support to the DeFi ecosystem.
Okay,
and
so let me go there. Sorry to interrupt, but let me go there. We know that stable coins are not always stable. In fact, it's worse than that. In troubled economic times, people are most likely to cash out of risky financial products and move into real dollars. Stable coins will take a nosedive precisely when people...
You should not do that. Okay? That's actually backwards thinking. In troubled times, cashing out into a currency that is experiencing those troubled times is not what you want to do. You want to be invested into hard assets that's going to scale with the inflation of whatever currency that you're participating in within society. And so even her saying stuff like that is kind of funny, because you know that that's not the way that she is functioning financially within troubled times. I just want to make that clear. That's backwards thinking.
People most need stability, and that run on the bank mentality could ultimately crash our whole economy. But there's another piece of the risk here, and you've headed in that direction, Professor Allen. DeFi is the most dangerous part of the crypto world. This is where the regulation is effectively absent, and no surprise, it's where the scammers and the cheats and the swindlers...
The point of DeFi is to keep regulation out. It's a way to enable the users to participate within their own financial responsibility and well-being without the interference of governments and banks regulating them. Now, this is what the fear is going to be, the fear mongering and so on from the governments and the banks when they want to maintain control of these and take a rake on all of them because they're too lazy to get real jobs.
Mix among part-time investors and first-time crypto traders. Shoot, in DeFi, someone can't even tell if they're dealing with a terrorist. Stablecoins provide the lifeblood of the DeFi ecosystem. In DeFi, people need stablecoins to trade between different coins, to trade derivatives, to lend and borrow money, all outside the regulated banking system. Without stablecoins, DeFi comes to a halt. So, Professor Allen, does DeFi threaten our financial stability? And can DeFi continue to grow without stablecoins?
I don't think DeFi can grow without stablecoins. I think it would struggle. Right now, I think DeFi is contained to the point where it won't impact financial stability. But if it grows, I think there's a real threat there.
Okay, actually, really important question here. Yeah, I was muted for the video. Somebody asked, is a GPU a hard asset? And yes, that is true. It is a hard asset. So don't, it's actually a little confusing because it is the asset that allows people that don't make enough money for other hard assets, let's say like, you know, real estate and so on, to actually start investing properly or from the mindset of the wealthy. And while it's at a very low threshold, especially in the past, it has a very good uptick and it starts programming your thinking properly. So let me put it this way, right? Like once you start building mining rigs and you start taking that profit and buying more GPUs and buying more rigs, then you've clicked into the mindset of the wealthy and not the mindset of the poor. Once you're taking that profit and you are purchasing things that make you more money, which are the said GPUs, however little money that is, whether it's $2 a month or $2 a day, right? That is the proper mindset. If you're spending $300 to make $1 a day, you're making $30 a month, then you are correctly moving forward into the mindset of the wealthy and moving out of the mindset of the poor, where you're just struggling to pay your bills and you think you need to work more hours and get more jobs to basically function. The people that are super wealthy don't actually need to go do whatever jobs they are doing, especially if we're talking about people within the government, because the reason they have government jobs, at least in recent years, from what I can tell, is so that they can help influence the decision making surrounding their assets.
Particularly if it becomes intertwined with our traditional financial system. And there is industry interest in pursuing this integration on both the traditional finance and the crypto side. So I think it's critical that stablecoins not be allowed to fuel that growth.
Well, I appreciate it. You know, this is risk to traders, risk to our economy. The time to act is before it all blows up. Stablecoins have no regulators, no independent auditors, no guarantors, nothing. And they are propping up one of the shadiest parts of the crypto world, the place where consumers are least protected from getting scammed. Our regulators need to get serious about clamping down on these risks before it is too late. Thank you, Mr. Chairman.
All right, so you have to start asking why they want to clamp down on the stable coins. Why is the attack on decentralized finance and so on? I think we covered pretty much everything from the perspective, the kind of wording that she uses, which is like, I think the important thing is to understand that the wording she's using is almost trying to put into the public mindset that during an economic downturn, they should basically be moving back into the US dollar when that is probably the last thing that you want to do, because they need people to be invested in that currency, right? That's what they need. And so just keep your eyes open, stay, woke as far as within the financial crypto space and just the financial space in general, and keep that in mind. I hope you enjoyed this clip from the Crypto Mining Morning Show every Monday through Friday, 7:45 a.m. Pacific and 10:45 a.m. Eastern Time. You can check out more clips here, or if you're interested in checking out the entire live show, you can check that out down here. Thanks for watching, and I'll see you next Tuesday.